In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Facebook shares sink with another bombshell. The New York Times reports the social network cut special deals with 150 companies to share more data than it disclosed. And the first big suit by U.S. regulators is filed against Facebook over Cambridge Analytica. Plus, how DoorDash went from hemorrhaging cash to becoming one of the fastest growing startups in the crowded and competitive food delivery market. We'll speak to CEO Tony Xu. And why did Elon Musk hold a big celebration for the Boring Company? We'll dig into his plans for the tunnels. But first, to our top story. 9 months after a scandal erupted over Facebook's open borders of user information, those borders are under scrutiny yet again. The New York Times reports that after Facebook tightened rules in 2015 to limit the user information that could be hooked into outside companies' apps and websites, the company made many exceptions and cut special deals with certain companies as well. For example, Facebook gave Spotify and Netflix the ability to read, write, and delete personal messages. Amazon, Sony, and Microsoft could get users' email addresses through their friends. Facebook helped Apple hide any signs that its devices were asking users for data. Even the New York Times itself got access to friend lists to enable article sharing. In all, 150 companies had access to more data than Facebook disclosed, impacting hundreds of millions of users every month. To discuss, I want to bring in BTIG analyst Rich Greenfield, who currently has a buy rating on the social network. Also with us, Bloomberg Tech's Sarah Fryer. So, Sarah, let me get this straight. Facebook gave Spotify and Netflix the ability to read, write, and delete my personal messages. What exactly does that mean?
So if you break it down, what Facebook is trying to allow you to do here is use Facebook in a way that was better integrated with those apps. So you could send a song to a friend, you could send a show to a friend, and you wouldn't have to go straight to Facebook and copy paste. It was just integrated. So you need to have the read permissions, the write permissions, and delete permissions. Say if you wanted to delete a message, it would also delete it in your Facebook chat history.
If they wanted to,
here,
could Spotify and Netflix go in there and read something I sent to a friend in 2013?
That's unclear here, right? The Times doesn't go into that detail. Facebook doesn't go into that detail in its response. What I really want to know is, there's a big difference here between allowing you to do that kind of messaging, send a song to a friend, and being able to read all of your personal messages with people who aren't even using Spotify. And it's not clear where on the spectrum this falls. What matters here is that Facebook said that post-2014, it really wound down all of those deals to share data with third parties. They said that to Congress. This is an example of how that wasn't quite true.
Right, and according to the New York Times, one of these deals was ongoing with Yahoo as recently as this summer. Now, in this statement, Facebook has a post in its newsroom today. To be clear, none of these partnerships or features gave companies access to information without people's permission, nor did they violate our 2012 settlement with the FTC. Facebook, Rich, is saying that partners didn't use this data inappropriately, even though, there's certainly no way to verify that. Now, do you think at this point that all of this bad news is going to start to impact growth?
I go back to what Sarah just said. You think about a consumer. You take a song on Spotify and you want to share it with a friend. Copying a link to that song and going into Facebook and looking up your friend and pasting it in is cumbersome and certainly not user-friendly. And I think Facebook very much wanted to be, or has wanted to be since the earliest days, the social layer that connects you and everyone that you're friends with across the internet. And I think many of the things that you're talking about, or at least that the New York Times is talking about, tie back to wanting to be that social connectivity, log in with Facebook, share content with your friends from other third-party sites. This was to make your life better. I know it's really easy in the kind of the maelstrom that Facebook seems to be stuck in right now. It's really easy to say the company had evil intentions with all of this, but it really does seem that from a consumer standpoint, this was actually done to make make the consumer's life easier. And I think it's in part why consumers like using Facebook and Instagram so much, is that they made life easier than what life was like before those two applications existed. And I think the reality is,
Rich, I don't think, I mean, yes, this is making it easier for consumers, but the problem isn't so much what they did, but how they talked about it. They were telling people that they had full control over their data. They were telling people that they could opt out of these things, that these kind of deals weren't going on, and yet we hear that they are. And so even if this is something consumers want, was Facebook being totally clear with people about how it worked? And I think there are several examples this year, not just this story, that they weren't.
Right, but the article also says that Netflix was accessing people's private messages, and Netflix came out and responded that that actually isn't true. So, you know, just because you put words on paper doesn't mean every word is accurate or correct, or that even if the capabilities were there, that they were actually being utilized. And obviously it takes two sides to utilize data inappropriately, not just the person making it accessible, but also the person taking advantage of it. So there's two aspects to this, and I think we're purely focusing on the Facebook side of it and not on all of the third parties that were trying to leverage this data and information, and were they actually even leveraging it, or was it just simply that it was available, which I agree is an issue, but it's a very different issue than if it were actually being utilized with some evil or nefarious intent.
Okay, so let's talk more specifically about what Facebook got out of this as well, because, you know, some of the data that they got back from these companies enabled them to power the people you may know, Sarah, the people you may know feature, which many people, and I've seen friends suggested myself, who it feels a little creepy.
Right.
You hear about the horror stories, psychiatrists and patients being connected to each other when there's no reason that Facebook should have that information, or that those people would want to be connected more publicly. So talk to us a little bit more about what Facebook got out of this.
Well, Facebook is collecting data from every possible avenue it can, and even beyond this New York Times story. I had a separate discussion with Facebook yesterday about location data. There were some users on Medium who posted a story about how they turned off location tracking on their Facebook app. Says never allow this app to track my location, and yet they were getting location-based ads. Facebook later said, actually, you know, that's one way to turn off location, but we can always get your location in other means, and there is actually no way to opt out of location-based advertising on Facebook. And that certainly doesn't sound like what they were explaining about how you have control of your data. That's a completely different, like, they should be clear with people about exactly how this all works, because in confusion there is fear.
Now, Facebook shares have, of course, been suffering. I do have this chart in my GTB library showing the market cap as it rose up to the middle of this year and has started to decline and decline significantly. Rich, I know that you have been more optimistic about the idea that this won't impact growth significantly, that this bad news won't be bad for Facebook's growth. But I can tell you that, you know, not just as a journalist, but a user, these revelations bother me. I don't feel that I had this information when I signed up to Facebook. Are you changing your opinion at all that this will hurt growth?
You might want to look at the cookies that are tracking you on every device that you use, whether it's the mobile device that you have in your hand or whether it's your computer. But I would argue that you probably have hundreds of cookies tracking literally everything you do. Everything you click on is being tracked by some site. Advertising, I mean, the entire premise of internet advertising is essentially tracking you and everything that you do. Pictures you look at, pictures you click on, everything you do on the internet is being tracked and used to target in some fashion. And so this is a broader issue that goes well beyond Facebook. I think the reality is, you know, this is a great story from you know, what I would call DC and, you know, the tech industry overall. I think when you look at consumers, I mean, look, consumer usage of Facebook Blue, kind of the core application, has been in decline, not in terms of users as much as just time spent has been shifting. And without a doubt, that time's been shifting to Instagram, and you've seen explosive growth of Instagram over the past couple of years. I think that's very much unchanged. And so I think consumers love using these applications. They continue to love using these applications. There isn't a great alternative. Like if you say you're not going to use Instagram to share photos with friends and family, what exactly are your obvious alternatives? When you think about, you know, messaging your friends overseas, like WhatsApp is the default application that almost everybody on the planet is using. And so I think, you know, not only is there not really good user alternatives, people actually like using these products. They have obviously embraced stories tremendously over the past 12 months on Instagram. But then I also think the advertiser side of it, I think what kind of gets lost in terms of the overall story around Facebook is that there is not great alternatives. If you're a small business, remember the bread and butter of Facebook and Instagram is not large multinational companies. It is literally the millions of small businesses all over the world which can target consumers, again, using that data that is targeted all over the internet, but using data to target ads at you and make it so it's not like TV, where the TV ads are untargeted and generally boring and uninteresting. The reason that ads on Instagram are so good is that they are targeted for you, that things you'll be interested in and almost feel like content. I think that reality is lost, that there really isn't great choices for advertisers to look for on the internet. It's Google and a Facebook world online, and there are not great alternatives right now that are scaled. And so I think the actual revenue growth that's occurring at Facebook is a lot stickier than investors right now are giving it credit for. I think this is certainly fear, and the fear obviously is not subsiding anytime soon with stories like today. But I think the reality is that the business is far more secure than people realize.
You're absolutely right that other services, Google, Twitter, also need to be scrutinized more, need to be more transparent. But, Rich, I'm not sure regulators and lawmakers are convinced that this isn't a Facebook, you know, more specific issue. We got this tweet from Senator Mark Warner today. It is beyond obvious at this point that social media platforms are simply not up to the task of voluntarily ensuring the privacy and security of their users. Congress might step in. The FTC this spring opened a new inquiry into Facebook compliance with that consent decree from 2011. The DOJ, the SEC are investigating Facebook. And just today, Facebook was sued by Washington, D.C. over the Cambridge Analytica scandal. How concerned are you, Rich, about regulation?
I think some regulation,
legal scrutiny.
Look, I guess regulation would be good. I mean, I think laying some basic ground rules, not just for Facebook, but as you said, the broader internet would certainly be helpful. Hopefully a bit more interesting than GDPR, which seems like it's more of an annoyance to consumers than it actually has any real benefit to consumers. But, you know, some level of regulation. I don't think if you talk to the Googles and Facebooks of the world, I don't think they're against regulation. I think some basic ground rules would be helpful. But, you know, I'm not sure how the government comes to that. I don't know what regulation actually looks like and how you define kind of regulating the internet. That is not an easy thing to do. And we have a pretty divided Congress, as you obviously know, heading into 2019. So we'll see. But I don't actually think regulation at some basic level, I think it actually would make it easier. And I think, again, companies that would benefit, Google and Facebook, would seem to stand to benefit just because they have the ability to build their business and adapt to that regulation. Might be much harder for small startups to really build themselves within that regulated world.
So here's a bigger picture question, Sarah. Is Facebook too big to be governed by anyone, any executive, any government? Is it just too big for its own good?
Well, the DC lawsuit in perspective, right? That is a tiny constituency of users. This company has 2.5 billion people using its products around the world. Governments want answers in almost every one of those countries for various things that are going on, not just this privacy stuff, but conflicts fueled by fake news and other issues that they've seen. I mean, the thing that's a problem here is there's just going to be a constant drumbeat of scrutiny from here on out, and antitrust might be part of that. That would be the thing that Facebook would be afraid of more so than these data regulations. But certainly GDPR is already becoming a problem for them. The Irish data protection entity is already investigating Facebook on several fronts based on the data breaches they've had this year. So I think that they're going to continue to be on the defensive, and the problem is, are they going to be able to live up to the promises they've made to change?
Right, and
but I think
whether a consumer protection law. Rich, I love debating with you. We're going to have to leave it there. As I'm about to say, there's a consumer protection law, and whether we need one of those in the United States, similar to GDPR. Rich, great debating with you. Rich Greenfield, BTIG, Bloomberg Tech Verifier. The story is not going away, so we'll continue to have this conversation here. Coming up, DoorDash was about to be left in the dust by the food delivery competition. Now the company is growing faster than any of its competitors. We will speak to the CEO. That's next. This is Bloomberg. A year ago, DoorDash looked like just another meal delivery app, facing stiff competition and thin margins. The company was burning cash as it struggled to differentiate its product from Uber Eats, Grubhub, and more. Then things turned around. DoorDash started turning a profit. That is, minus overhead expenses like salaries and rent. Granted, that is a generous definition of the word profit, but it was enough for SoftBank's Vision Fund, which swooped in to lead a fresh round of investment totaling $535 million. Here to discuss the future of the company and food delivery, DoorDash CEO Tony Xu. So I'm going to double down on the fact that that's a generous definition of profit, because salaries and rent are part of everyday business. So just, how well is the business doing from a revenue generating perspective?
Well, the business is on fire. We have tripled sales in a year. We're north of $1.25 billion of net revenue. There are maybe a handful of consumer businesses that can say that, and no one can say that they're growing that fast. In the business, in the industry that we serve, the restaurant delivery business, we are gaining share faster than anyone. We're growing faster than everyone, and we're on track to be the largest platform in the space.
So how do you translate that into actual profit, including the overhead costs?
Well, our earliest markets are profitable, including salary and rents. So we've had a playbook on how to turn businesses from investment mode into growth mode into cash flow positive. And it's only after that playbook that was developed that we decided to raise financing in March and then later on in August.
Now, we had the head of Uber Eats on earlier this week, who also said the business is growing, way faster than even they expected. They're doubling down. They're exploring grocery delivery, and they have big, deep pockets now too. How do you stand up to the competition?
Well, we already have. What
are you doing to differentiate yourself?
Well, a lot of the work that led to the results in 2018, where DoorDash is on track to be the largest in the restaurant delivery space in the U.S., happened before 2018. Since day one, we've had a differentiated strategy of focusing on the merchants. By building more services like DoorDash Drive, which builds channels for the merchants to deliver their own orders, we've signed up more merchants than anyone else, including the most demanding merchants. We have 90% of the top 100 merchants signed. That's more than all of our peers combined. We are also delivering other types of meals. We started with food, which is the hardest in terms of perishability, but our partnership with Walmart that started in April of this year has now reached over 500 stores, and we deliver the vast majority of Walmart's groceries.
So where do you think this is going? I mean, do you think there will be a few established players? Do you think some smaller players will go out of business? Because it doesn't seem like this many different food delivery players will survive in this market.
I think you're starting to see some of that evidence. It is a vast market. So let's start with where things are. 30 years ago, 5 to 10% of pizza sales were delivered. Today, when you think pizza, you think delivery, and over half of pizza sales are delivered. Today, outside of pizza, only about 8 to 10% of sales are delivered. So what you're seeing is the beginnings of an industry that's much, much bigger than any of the industries that have come before us in the consumer space since 2010. Second, you're seeing that both talent, capital, merchants, relationships, partnerships are accruing to a couple of national players, and DoorDash is leading the field. So
where are we going to see you expand? How are we going to see you use more of this SoftBank money?
Well, DoorDash started the year with 600 cities. We're now in 3,000. When we spoke in March, I think I mentioned that we would be in 2,000, so we're well ahead of a goal. But that said, we still have a lot of the U.S. left to serve. We serve the largest coverage today in the U.S., but there's still 25 to 30% of households that we don't serve in the U.S. So we have to get into more cities. Second, we're continuing to expand DoorDash Drive. Today, we deliver Drive with partners like Chipotle, Wingstop, and Walmart. There are many other businesses for them to survive the next decade that need to build their own e-commerce and fulfillment channels, and we're going to be their partners to do that. And there's other products that we have in order to continue on our merchant-first approach that will give customers more selection at higher quality, and that's what keeps the customers coming back.
All right. DoorDash CEO Tony Xu, great to have you back here on the show, and congrats on hitting those milestones. Thanks for stopping by. Coming up, SoftBank's telecom business had a weak public debut in Japan, hurt by concerns over an impending price war that could hit profits. We will have details from the ground in Tokyo next. Shares of SoftBank's telecom unit had one of the worst first-day declines ever for a Japanese IPO, falling more than 14% in Tokyo Wednesday. This comes after much buildup and fanfare. The company is among the largest IPOs in history. Bloomberg's David Ingles reports from Tokyo.
A lot of reasons why this deal didn't fly, at least in the first day of trade. I mean, you look at market conditions, hardly, of course, the best time to hit the market with such a large listing. It was the second largest in history globally, over $23 billion raised. We're this close to Christmas. There's a lot of volatility in the markets. And, you know, a lot of people approaching today had already warned that this IPO was a little bit overpriced, especially if you talk to foreign institutional investors. Now, if you talk to retail investors, it was sold differently. They saw something different in this IPO. What they saw was a national champion. Masayoshi Son, the founder, of course, of SoftBank, is a household name here in Japan, a visionary, if you will. And it was sold as a dividend play. If you bought at the IPO price at $1,500, you would have gotten about a 5% dividend yield. And the company had promised an 85% dividend payout ratio on net income, and that translates based on the IPO price to about 5%. Now, obviously, if you buy into at these prices, that yield play then goes up a lot further. Now, the question really here, and this is where it gets tricky, if you ask foreign investors, they look at that net income, that denominator when you try and calculate it, and what they're seeing is it's the third biggest player in a market that's mature, likely going to be under pressure from the government to lower their prices, as we've seen in recent weeks, and there's a fourth player coming in. So it's hardly a very good sell to foreign investors. It's going to be interesting to see how this pans out ahead, because as I mentioned, it was sold as a dividend play, and at the moment, given the price, 14% drop, you're going to get a lot more dividend yield. Let's call it a soft opening for SoftBank. In Tokyo, I'm David Ingles, Bloomberg.
Now, out of the UK, Uber has lost a bid to overturn a court ruling that allows drivers to get a minimum wage and holiday pay. The Court of Appeal dismissed the ride-hailing service's challenge today. It is the third time Uber has lost in the lawsuit. According to a spokesperson, the company will now take the case to the Supreme Court. And new details on Anthony Lewandowski's next act, the guy at the center of that lawsuit between Google and Uber. He's launched a new self-driving startup called Pronto, which uses cameras over LiDAR for assistance. He, of course, worked for Google's Waymo unit before starting his own self-driving company that got bought by Uber and became a flashpoint in that trial. More on Facebook next. This is Bloomberg. Technology. I'm Emily Chang in San Francisco. Back to our top story. Facebook was sued by the District of Columbia over a privacy breach in which personal information of millions of Americans was transferred by an app developer to Cambridge Analytica. The suit alleges Facebook violated the Consumer Protection and Procedures Act as a result of lax oversight of the company's third-party applications. This came after a separate report from the New York Times that the social media giant allowed more than 150 companies to access users' personal data, more data than it had previously disclosed. For more insight, I want to bring in Matt Schettenhelm, who covers litigation and government at Bloomberg Intelligence. So, Matt, how serious is this suit filed by Washington, D.C.?
Yeah, Emily, I think it is something that Facebook has to take very seriously. The story keeps getting worse for Facebook by the day, and its legal risks are going up at the same time. This is a sign of that. The real risk here is that this may just be the first of many suits by the states. This suit will just be aimed at protecting D.C. residents from Facebook's alleged practices. What you could see, though, is more suits jumping in and doing the same thing. And states have pretty broad powers to impose civil penalties for practices that are found to be deceptive. All of this also relates to the larger investigation at the federal level from the Federal Trade Commission.
Right. So the FTC this spring opened a new inquiry into Facebook compliance with that 2011 consent decree that was put into place because of Facebook privacy violations from earlier years. On top of that, the DOJ and the SEC are investigating the company. How does this fit in with the newest lawsuit today?
So it's directly related to that. States have very similar authority to the Federal Trade Commission to look for deceptive and unfair practices from companies. And so what we're seeing with this suit is exactly what the Federal Trade Commission is investigating right now. Remember, at the federal level, there's almost no regulation of these companies. It's something Congress is exploring now. But as you said, Facebook is bound by this 2011 consent decree. And what the New York Times story raised it last night is, are there new violations of that consent decree that the Federal Trade Commission could be presenting very, very soon here? And the real risk to Facebook is that every violation potentially leaves it on the hook for $40,000 per violation. When you have a company that serves the number of users that Facebook does, the threat is serious. This could lead to billions of dollars in damages from the Federal Trade Commission. You could see these states following up with their own suits doing the same thing. This is a serious risk for the company.
Now, Facebook executives have been apologizing over and over again. They've testified before Congress. Take a listen to what Sheryl Sandberg had to say about personal data back in April.
We know that we did not do a good enough job protecting people's data. And I'm really sorry for that, and Mark's really sorry for that. And now what we're doing is taking really strong action.
That's from an interview I did with her several months ago. Since then, more and more revelations and more indications that Facebook hasn't been transparent with these revelations. How are the statements of Facebook executives, the testifying before lawmakers, the lobbying that Facebook is doing on Capitol Hill, how is that impacting the actions that we're seeing taken here by the U.S. government?
I don't think it's going to have a significant impact at all. If anything, it may be hurting the company. As these stories come out, the momentum is against the company. This stories like the New York Times story last night, the lawsuit today from D.C. is only going to up the pressure on regulators, first at the Federal Trade Commission, those in other states, to really go after the company. And then looming behind this is Congress getting ready to look seriously at imposing federal regulation. The company can apologize and say that it's trying its best, but I'm really skeptical that's going to be enough in this environment.
Matt Schettenhelm of Bloomberg Intelligence. Lots of legal issues. I know you'll continue to help us follow. Thanks so much for stopping by. Big tech, and especially Facebook, has been taking a beating. But what does it mean for the rest of Silicon Valley? This year's venture capital investments in the United States are expected to reach $100 billion. And we've seen several companies like Xiaomi, Dropbox, and Spotify hit the public market. Late-stage venture capital firm IVP was an investor in Dropbox and had a big year in M&A as well. So what will 2019 bring? With Uber and Lyft poised to go public, here to discuss the year ahead and the year that was, IVP General Partner Sandy Miller. So, Sandy, thank you for being here. Obviously, sure. Facebook is in the news today. Do you think this bad news about Facebook is going to have a drag on the broader industry?
I don't think so. I think it's isolated with the, my perspective is the young emerging tech companies in the U.S., typically venture-backed, and they're pretty far afield from what the tech giants are doing in a lot of ways. So I think it's more isolated than that. I don't think it'll impact the investment climate for the young emerging companies.
Do you think it will reveal an actual opening for startup social media companies or startup social networks to have a chance? We just had an analyst on earlier who said, well, everybody wants to use Instagram, so nobody else has really succeeded. Look at what's happened to Snapchat. Is there a company now that could have an opportunity to disrupt?
Well, I think it certainly creates maybe a bit more of an opportunity, but Facebook still has such broad tentacles. I mean, there's already other social media platforms, that have made inroads, but I think a pure startup in the area is still pretty tough.
So, what are you optimistic about in terms of trends for next year?
Trends in terms of the types of companies or the marketplace, or
both?
Oh, okay. Well, I think the environment is super healthy overall. I mean, what we had in 2019 was we hit kind of a peak in private valuations on the private side, and they were very, very heady. We've moderated somewhat from that. They're still high at a historical level, so very attractive for companies to sell shares. But I think investors feel there's still value, and they can. The discounts from public comps in some cases have become realistic again versus having almost premiums to public comps. So I think it's a healthy supply-demand balanced environment. I think it's going to be a big year for private investing. You mentioned at the outset the amount of investment that took place in 2018. I expect to see 2019 stronger than that.
Despite the volatility in the public market.
Despite the volatility in the public market, I think the public market in 2019 will be the best in quite a long time.
Why?
Well, because we're poised for it. We've been building for it for years. So there's today a larger group of private tech companies. I'm really only speaking about tech companies in the U.S., but a large group of private tech companies in the U.S. that have scale, let's say 50 to 100 million in revenues, and are growing, let's say 40 to 100% a year. And those kind of companies are eligible to be in the IPO market, but most of them have been kind of holding back because private money has been quite available. But at some point, it's not just getting the capital, but it's getting the visibility of a public offering, the liquidity, and it's healthy for the companies and overall for the ecosystem. So I think people have been poised. So right now, there's more companies on file silently, and the silent filing has been a huge blessing. Thank you, Jobs Act. There's more companies on file silently in the tech space than ever before. If those companies simply went public in 2019, and not all will, but others will come in that are not on that list. If that list went public, it'd be the biggest year in more than a decade.
Uber and Lyft poised to file. Lyft, silent filings, but Lyft, announced.
Right.
It's filing. That said, a skeptic might say, given this volatility, they're going to get dragged into that.
Well, people. First, the great tech companies have gone public in every market. You think about when Microsoft went public, Apple, Google, none of them went in buoyant markets, and not all of them had really successful IPOs, actually. But all became, obviously, some of the biggest value builders of all time in any industry. But so I think the ability now with the silent filing and testing the waters, two aspects of the Job Act, allow a company to move swiftly and complete an IPO in a way that was simply not feasible 5 or 10 years or 25 years ago. So you can time the market in a way that we never could before. And that's a big advantage. So I think in a market full of volatility, I think people can find their slots to make it happen.
You've had some big exits this year. I mentioned Dropbox going public, Domo, another one of your companies going public, GitHub getting bought by Microsoft, MuleSoft by Salesforce.
Right.
Where are you going to be putting your bets this coming year, given the competition from SoftBank in the late-stage investing market?
Yeah, from our perspective, SoftBank isn't a competitor. The scale of their funds and the scale of investments they're looking for simply, it's just a different business than we're in late-stage venture capital. So the venture business has become a big business with a lot of segmentation. We don't compete with early-stage venture firms, but we also don't compete with SoftBank. So there's big niches for big segments for individuals, but because they're looking at for us, they're more likely to be either a follow-on to something we do or an exit strategy, because I think they're going to build a tech conglomerate.
All right. General Partner at IVP, Sandy Miller. Good to have here.
Great. Thank you, Emily.
Thanks for stopping by.
My pleasure.
The European Union is investigating a potential leak of sensitive information, quote unquote, following a report that hackers breached the bloc's diplomatic communications network. According to the New York Times, hackers got access to the EU's diplomatic communications, including thousands of cables that reveal concerns about Donald Trump's administration, struggles dealing with Russia and China, and Iran's nuclear risks. Certainly a story we will continue to follow. Coming up, the Boring Company has opened up its first underground tunnel for demonstration. How the underground tunnel network could transform the future of transportation. Plus, Facebook's leadership is called into question after a year of scandals and controversies. We will hear from former Cisco CEO John Chambers, who thinks Sheryl Sandberg and Mark Zuckerberg can weather the storm. This is Bloomberg. It's been a difficult year for Elon Musk, but not for his Boring Company. On Tuesday, the company unveiled its first completed underground test tunnel in Hawthorne, California, putting them a step closer to realizing Musk's vision of a zero-emission, high-speed transit system that he hopes will alleviate traffic in LA. Musk's test tunnel runs for just over a mile alongside the SpaceX headquarters and will eventually hurdle cars along it at speeds of up to 150 miles an hour. Musk claims to have poured about $40 million of his own money in the 2 years into this project since its founding, and the company is currently looking to build similar tunnels in Chicago and D.C. Here to discuss, Bloomberg's Sarah McBride, who was at this event. So, Sarah, what happened there?
Well, the event was super fun, lots of razzle-dazzle, all kinds of celebrities and people just wanting to take a ride in the car. Elon was there, his girlfriend Grimes was there, his mom was there, and it was super fun to get a ride in the cars.
So talk to us about what that was like.
So the trip I went on was a little bit space agey. You got in a modified Tesla, and it's been modified so that the wheels can fit along grooves at the side of the tunnel, and you descend in this Batman-like elevator, and you come out into a tunnel, a small tunnel with a lot of flashing lights, and then the car kind of takes off. And it has to be a self-driving car, though Elon Musk says in future it won't have to be a Tesla. All the demonstrations yesterday were on Teslas.
So next step for Boring Company, Elon Musk just tweeted this. Loop is demonstrating high throughput at high speed. Target is 4,000 vehicles an hour at 155 miles an hour. So walk us through how this actually works at scale. It sounds like just a car on a track.
Right. So in one sense, it's really old school. As you say, it's a car on a track in a tunnel. But because it's automated, Elon Musk thinks there will be many, many cars going together, probably a lot tighter than in existing tunnels. And it won't just be one tunnel. He's hoping that in the future, it'll be layers of stacking tunnels. So even though one car at a time can fit per tunnel, if you have a row of 3 or 6 tunnels, that's a lot more cars traveling at once. And because they'll be going up to 150 miles an hour in these giant networks he envisions under cities, if that happens, it could take some congestion off the streets.
So what sort of firm interest has there been from cities? I mean, is the idea that cities will just order up a tunnel?
Well, there were a lot of city officials at the event last night. There was a whole delegation from the city of Chicago, which has entered into exclusive negotiations with the Boring Company to build a high-speed train to the airport. So when I say train, I should say loop, but they are putting the finishing touches on that deal. The Boring Company has been talking to officials on the East Coast about a tunnel going between Washington, D.C. and Maryland, Baltimore, Maryland. The environmental review for that tunnel has already started. And here in LA, he's also talking about building a tunnel from Dodger Stadium to the Metro Red Line. And all kinds of cities are interested in using these tunnels for utilities, he said. He said he's fielding 20 inquiries a week from cities that might want to use these tunnels for electric cables or water, things like that.
All right, fascinating development. Sarah McBride on the Anything But Boring company in LA for us. Thanks so much, Sarah, for sharing your report. Meantime, NASA has disclosed it is investigating a hack of employee information of both current and former employees. Those who were hired, transferred, or left the agency from July 2006 to October 2018 may have been impacted. The agency said it doesn't believe that any of its missions were affected. Still ahead, highlights from our conversation with former Cisco CEO John Chambers, including his thoughts on improving gender diversity and whether big tech companies can recover from tarnished reputations. This is Bloomberg.